Welcome to the Deep Dive, your shortcut to understanding the complex world around us. Today, we're plunging into a topic that truly acts as the nervous system of any thriving economy: financial markets. They're constantly buzzing, reacting, channeling vital resources. It makes them a fascinating landscape to explore. Our mission for this deep dive, well, it's to demystify India's capital and secondary markets. We've pulled together a whole stack of sources, articles, research, our own notes to guide you through how money really moves,
Right.
who the key players are, and crucially, how global shifts and domestic policies ripple through it all. You're going to walk away not just informed, but with a perhaps deeper appreciation for how this intricate system impacts everything, from big projects to your own finances.
And it's quite a system. When we talk about India's financial markets, we're looking at a history stretching back over 200 years. It evolved really in the late 18th century during East India Company rule.
Wow, that far back.
Yeah. And what's remarkable is that this ancient foundation now supports one of the fastest growing financial ecosystems among emerging economies. Mumbai is still the historical hub, of course. It's this compelling blend of tradition and, well, explosive growth.
So let's start at the very beginning then. What is a financial system in India exactly, and why is it so indispensable for economic growth?
At its core, it's the mechanism that takes savings from households, businesses, wherever, and channels them into productive uses.
Like factories, startups.
Exactly. Trade, commerce, manufacturing. It turns maybe a family's savings into capital for something bigger,
Okay.
and it covers everything: credit, cash, all sorts of financial assets and instruments.
Okay. And it's built on key components, right? The market itself, the assets, services, institutions.
Precisely. And its growth is tied to so many things: savings levels, taxes, the economy's general health, corporate performance, even common living patterns.
So the health of the economy, we measure that with things like GDP growth, interest rates, inflation, foreign exchange reserves.
Right. And that connection you mentioned, channeling small savings into big projects, that really gets to the heart of it. How does this system enable, say, a huge infrastructure project and let a small investor participate?
That's the interesting part. And to understand that, we need to distinguish between the two main halves: the money market and the capital market.
Good distinction.
Think of the money market as like your day-to-day cash flow management. It's for short-term needs, borrowing, lending, usually from 1 day up to a year.
Very short term, yeah.
It's dominated by big players, institutions doing high-volume transactions, both RBI and SEBI regulated. We're talking treasury bills, commercial paper, things for quick liquidity.
Right.
The capital market, on the other hand, that's more like your long-term investment strategy. It deals with industrial securities, government bonds, long-term loans, things for medium to long-term funding needs.
Building assets.
Exactly. It pools funds for businesses, government projects, individuals too, and it lets people trade securities that have already been issued.
And that's the crucial difference, isn't it? Money market is for working capital, the day-to-day stuff. Capital market is for the creation of an asset base, long-term growth.
Which means the tenure is different.
Short versus long,
Risk is different.
lower versus higher, generally.
And potential returns too.
Lower versus higher again.
Yeah.
That's why the capital market is often called the barometer of the economy. It really reflects that long-term confidence, those growth prospects.
So why does this capital market matter so much for you, the investor, and for the economy?
Well, it's an incredibly efficient way to channel funds to where they're needed: enterprises, projects,
It provides investment options.
crucial ones. It turns savings into productive assets. That's fundamental for long-term growth, making India more competitive globally.
And for investors, it allows diversification, managing risk.
Absolutely. Plus, it pushes for better information quality, stronger corporate governance. Think about it: financing huge capital-intensive projects, almost impossible without a deep capital market.
Even back in the Industrial Revolution, or with the new economy tech boom.
Exactly. It also enables things like ESOPs for employees, or companies acquiring others using share swaps, and it's vital for venture capital and private equity funds. It gives them an exit route for their investments.
Okay, so we understand the landscape. Now, who are the major participants bringing this capital market to life? Let's start with the heavy hitters. Qualified institutional buyers, QIBs.
Right? These aren't just any large investors. They're institutions perceived to have the expertise and financial clout for large-scale investing. Think mutual funds, pension funds, insurance companies, certain banks.
And they often investors, FPIs, their money flows can really move the needle.
Definitely. They're split into categories. Category 1 is the more official side, government-related entities, sovereign wealth funds, regulated players like banks or asset managers from FATF countries.
Okay.
Category 2 is basically everyone else. Endowments, charities, corporate bodies, even individuals. They represent that global investment interest in India.
Next up, alternative investment funds, or AIFs. These sound interesting.
They are. They're privately pooled funds. Can be a trust, a company, an LLP, that fall outside the regulations for, say, mutual funds or other regulators like IRDI or PFRDA.
Sort of the specialized investment vehicles.
Exactly. And they come in 3 flavors. Category I focuses on startups, early-stage ventures, or socially desirable sectors like infrastructure or SME funds. They often get government incentives. Category 2 is more mainstream private equity and debt funds without those specific incentives. And Category 3, well, they use more diverse, complex trading strategies, often with leverage. Think hedge funds.
Now, you mentioned private equity. People often confuse venture capital and private equity. Let's unpack that.
Good idea. Venture capital is typically about equity investments made by funds at a very early stage in private companies. These companies usually have high growth potential, often in tech or innovative sectors.
Like India's software boom.
Precisely. Promoters give up some ownership to get that vital early capital. Private equity, on the other hand, usually invest in more mature private companies, or they might take a public company private.
And they often use debt, leveraged buyouts.
Very often, yes. The capital comes from high net worth individuals or firms, and the goal is often restructuring or scaling the business for significant value creation.
So the key difference is stage and focus. VC, early stage growth. PE, more mature. Buyouts, optimization.
That's the essence of it. VC embraces higher risk for potentially massive returns from innovation. PE is often about improving or consolidating existing businesses.
Why take those high risks, though?
It boils down to the potential for outsized returns, the kind you just don't typically find in established public markets. That transformative growth potential.
Got it. And related to VC is the angel fund, right?
Yes, a subcategory of category IAIF. This is money pooled by high net worth individuals or corporates, the angel investors specifically for startups.
And they often bring more than just cash.
Oh, absolutely. Mentorship, connections, advice. They really nurture those early ventures.
Okay. Now, shifting gears to when a company goes public, the IPO. We hear about anchor investors. What's their role?
They play a crucial stabilizing role. Anchor investors are QIBs who commit to buying a large chunk of shares, at least 10 crore rupees worth, in a main board IPO before the issue opens to the public, using the book building process.
So they signal confidence.
Exactly. They can be allocated up to 60% of the portion reserved for QIBs, but their shares are locked in 50% for 30 days, the other 50% for 90 days to prevent quick flipping.
Makes sense. And beyond institutions, we have high net worth individuals, HNIs. What's the threshold?
Generally, someone with over 2 crore rupees in investable surplus. They're a significant force.
And pension funds. They must be huge players.
Massive. Established for retirement savings, managed either externally or in-house. They're major institutional investors, increasingly active in the Indian equity market, influencing long-term trends.
Okay, so that's who is involved. Now, let's talk about what they actually trade the instruments. We all know equity shares mean ownership.
Fractional ownership, yes. But the key takeaway is the risk-reward balance. Maximum entrepreneurial risk, you're last in line if the company fails. But also, potentially unlimited upside through dividends or capital gains, and you get voting rights.
Then there are those shares with differential voting rights, DVRs. Tata Motors use these, right?
They did, famously. DVRs are equity shares, but with different rights on dividends, or, crucially, voting. It allows founders or promoters to raise capital without diluting their control too much.
Are there limits?
Yes, the total voting power of DVRs can't exceed 74% of the total voting power, and companies with certain defaults can't issue them.
Okay. What about preference shares?
These are kind of a hybrid. They get preferential treatment for fixed dividends and capital repayment if the company winds up ahead of equity holders.
But less say in things.
Right. Limited voting rights, usually only on matters that directly affect their specific rights.
Then there's debt, debentures. These are basically IOUs from the company.
Essentially, yes. Certificates of debt. They have a fixed redemption date, pay fixed interest regardless of profits, and critically, have no voting rights.
And they come in different conversion types.
Correct. Fully convertible, FCDs, will convert into equity shares. Non-convertible, NCDs, remain debt throughout. Partly convertible, PCDs offer a mix. And Optionally fully convertible OFCDs give the holder the choice later on. That option can be very valuable.
Similar to debentures are bonds, also debt.
Yes, another debt security. Fixed face value, fixed maturity date, regular interest payments, the coupon, generally seen as less risky than equity, offering stability.
Now, you mentioned some clever international instruments earlier, FCCBs and FCEBs.
Yes, foreign currency convertible bonds, FCCBs. An Indian company issues these bonds in foreign currency. But the key is, they're convertible into the issuing company's own equity shares.
Why would foreign investors like these?
Several reasons. The interest and principal are usually paid in foreign currency, reducing their currency risk. They get the potential equity upside through conversion, and there can be arbitrage opportunities if the conversion price is favorable compared to the stock price.
Okay. And foreign currency exchangeable bonds, FCEBs, how are they different?
Subtly, but importantly different. Also issued by an Indian company in foreign currency. But these bonds are exchangeable into the equity shares of another Indian company, usually one within the same promoter group.
Ah, so not the issuing company shares.
Exactly. The strategic advantage is that the issuing company can raise funds without diluting its own shareholding. It's useful for group restructuring or financing specific projects in another group entity.
Clever. What about Indian depository receipts, IDRs? These let foreign companies raise money here.
Precisely. Standard Chartered PLC was the first major example. Indian depositories create these IDRs, which represent underlying equity shares of the foreign company. So Indians can invest in foreign companies directly on Indian exchanges.
But there's currency risk involved for the underlying shares.
Yes, that's an important factor for IDR investors to consider.
And warrants. They give you the right, but not the obligation.
Correct. The right to buy shares at a set price, exercise price, during a specific period. It's optional. You'd only exercise it if the market price is higher than the exercise price, making it profitable. Gives flexibility.
Now let's talk about making specific asset classes more accessible. REITs and invites. How do REITs work?
Real estate investment trusts. They're collective investment schemes. They pool money from many investors to own and operate income-generating real estate. Think office buildings, malls, warehouses.
So it makes real estate investing easier for smaller investors.
Much easier. Less capital needed. Plus, they're listed, so they offer transparency and liquidity. You get income from rent, often tax efficiently distributed as dividends, plus potential capital appreciation.
And NVITs are similar, but for infrastructure.
Infrastructure investment trusts, yes.
Yeah.
Same concept. Pool money to invest in income-generating infrastructure assets, roads, power transmission lines, things like that. Cash flows are distributed as dividends. They have a defined structure. Trustees, sponsor, investment manager, project manager, ensuring professional oversight.
Okay. 2 more instruments. Securitized debt instruments, SDIs.
These are created by pooling individual loans or debts. Mortgages are the most common example, and then selling slices of that pool as securities to investors. It diversifies debt exposure.
And municipal bonds, muni bonds.
Issued by urban local governments,
Yeah.
cities, municipalities to fund public projects, roads, schools, airports. Bangalore issued the first one back in 1997. SEBI brought in regulations in 2015 to try and revive the market, but liquidity can still be a challenge sometimes.
Right, so that's the what. Now let's zoom into where are the stock exchanges. They're the nerve center, aren't they?
Absolutely. They provide that regulated marketplace for buying and selling securities. They ensure liquidity, and their movements reflect the economy's health, or perceived health anyway.
And their role in economic development goes beyond just trading, right?
Profoundly. They mobilize savings, even small amounts, and channel them into development. They act as that economic barometer we talked about. They provide a continuous market, facilitate price discovery through supply and demand.
Protect investors through listing rules.
Exactly. Ensure only genuine companies get listed. They ensure liquidity, keep an eye on listed companies' reporting, attract vital foreign capital, and operate under strict rules for safety and fair dealing. They really underpin a lot of economic activity.
And in India, the 2 giants are BSE and NSE. BSE is ancient, 1875.
One of Asia's oldest, yes. Bombay Stock Exchange, now BSE Ltd. First recognized by the government in 1957, went electronic in 95, still a global force.
And NSE came later in 92.
National Stock Exchange. But it really shook things up, pioneered fully electronic trading in 94, and was India's first demutualized exchange, separating ownership from trading rights, a major modernization step.
So how do trades actually happen? Let's clarify primary versus secondary markets in practice.
Okay. primary market is where new securities are born. A company issuing shares for the first time at an IPO or issuing new bonds. Funds flow directly from investors to the company or government issuer.
It's not a physical place.
No, it's the process of issuance. The secondary market is the physical or electronic marketplace, the stock exchange. This is where securities that have already been issued are traded between investors.
The aftermarket.
Exactly. It provides the liquidity, it lets the initial primary market investors sell their holdings. Without a functioning secondary market, who would buy in the primary market?
Good point. So the core difference is purpose and fund flow.
Absolutely. Primary is for raising capital for the issuer, company to investor. Secondary is for liquidity and price discovery for investors, investor to investor. Prices are fixed in the primary offering, but fluctuate constantly in the secondary based on demand and supply.
Okay. And the mechanics of trading. Dematerialization has been key.
Hugely important. Converting physical share certificates into electronic form, held in a demat account, it cuts down massively on paperwork, time, errors, risk of theft, or forgery.
Makes trading faster, more efficient.
And gives geographical anonymity, equal access, a perfect audit trail. It's mandatory now for listed companies, most unlisted public companies, and even some private ones when issuing or transferring shares.
And settlement. How quickly do trades finalize?
Currently, India follows a T+1 rolling settlement cycle for equities. That means if you trade today, T, the transaction is settled by the clearing corporation tomorrow, the next working day, +1. Funds and securities change hands then.
But there's something newer happening. T+0.
Yes, this is quite exciting, though still in early stages. A beta version of T+0 same-day settlement was introduced in March 2024.
Wow, same day.
For a limited set of 25 stocks and specific brokers, and initially just for non-custodian clients. But it's a significant step towards even greater efficiency and reduced counterparty risk.
So who makes all this happen behind the scenes? The intermediaries.
Right. These are the SEBI-regulated service providers connecting investors and issuers. They all have defined roles, eligibility criteria, responsibilities.
Like depositories, NSDL and CDSL.
Yes, they hold the securities in electronic form. Think of them as banks for securities.
And depository participants, DPs, are their agents, where I open my DMAT account.
Exactly. Your broker or a bank acts as a DP. They're your interface with the depository, crucial for all transactions.
Then you have trading member stockbrokers and sub-brokers.
So they execute your buy and sell orders on the exchange.
Custodians. They handle things for big clients.
Yes. Mostly large institutional clients, banks, insurance companies, FPIs. They hold their funds and securities, settle trades, manage corporate actions like dividends or bonuses.
And the clearing corporation. Sounds important for safety.
Vitally important. They step into the middle of every trade, becoming the buyer to every seller and the seller to every buyer. They manage collateral, clear and settle trades, and provide a counterparty risk guarantee. They ensure that if one side defaults, the other side still gets paid. A cornerstone of market safety.
Finally, merchant bankers. They manage new issues.
Yes, they're SEBI-registered issue managers. When a company plans an IPO or another public issue, the merchant banker manages the entire process, coordinating all the other intermediaries, lawyers, accountants, printers, registrars.
Okay, quite an ecosystem. Let's move to some more specialized instruments and concepts. Exchange-traded funds, ETFs. How are they different from mutual funds?
Well, like mutual funds, they hold a basket of assets, stocks, tracking an index, commodities, bonds. But the key difference is ETFs trade on a stock exchange throughout the day, just like individual stocks.
So their price changes constantly.
Exactly, based on supply and demand and the value of the underlying assets.
Yeah.
Mutual funds are typically priced only once a day. ETFs offer intraday liquidity, often lower fees, and are useful for hedging or tactical asset allocation.
Okay. Now, derivatives. These often sound complicated.
They can seem that way, but the basic idea is simple. A derivative is a financial contract whose value is derived from an underlying asset. That asset could be stocks, bonds, currencies, commodities, market indices, anything really.
And they're used for hedging or speculation.
Primarily, yes. The two main types are futures and options.
Let's start with futures.
A futures contract is an agreement traded on an exchange to buy or sell a specific quantity of an asset at a predetermined price on a specific future date. It's a binding obligation for both parties.
Like currency futures, USD/INR.
Exactly. You lock in an exchange rate today for a future transaction. Invaluable for importers or exporters wanting to hedge against currency fluctuations or traders speculating on currency movements.
And commodity derivatives, oil, gold, same principle. Futures contracts based on underlying commodities. They offer diversification, often higher leverage, and exposure to global commodity markets.
Okay, so futures are an obligation. What about options?
Options are different. They give the buyer the right, but crucially not the obligation, to either buy a call option or sell a put option, an underlying asset at a specified price, the strike price, on or before a specific date, the expiration date.
So you pay for the choice.
Precisely. The buyer pays a premium to the seller, or writer, of the option. The seller receives the premium and takes on the obligation if the buyer decides to exercise the option.
And there are different styles, European versus American.
Right. European options can only be exercised on the expiration date. American options can be exercised anytime, up to and including the expiration date. Most stock options in India are European-style index options and American-style stock options.
Interesting. Now, something for existing shareholders. Rights, entitlements, what are these? When a company wants to raise more capital, it might issue rights entitlements to its existing shareholders. These give them the right to buy new shares, usually at a discount to the market price, in proportion to their existing holdings.
So it favors existing owners.
Yes, they're issued in demand form. And shareholders have choices. They can apply for their full entitlement, maybe apply for additional shares if others don't take up their rights, apply for just a part.
Or sell their rights, renounce them.
Exactly. They can renounce part or all of their entitlement. These REs actually trade on the stock exchange for a period, so you can sell them on market through your broker. Or you can transfer them off market directly to someone else via your DP. If you don't apply or renounce, the rights simply lapse.
Okay. Beyond the main trading board, India has specialized platforms too. We have the main board for the big established companies.
Right, meeting all the standard listing requirements.
But then there's the SME platform for smaller companies.
Yes, BSE, SME, and NSE emerge, tailored for small and medium enterprises. The requirements are different, like post-issue paid-up capital, generally not exceeding 25 crore rupees, specific net worth and track record criteria, though there are exceptions, mandatory website. It's a vital stepping stone for growing businesses to access capital markets.
And the Innovators Growth Platform, IGP. That sounds tech-focused.
It is designed for companies heavily using technology, IT, intellectual property, data analytics, biotech, nanotech, that kind of thing.
What are the entry rules?
The key requirement is that at least 25% of their pre-issue capital must have been held for at least a year by QIBs or certain other regulated entities like AIFs or foreign venture capital investors. The minimum application size is higher, 2 lakh rupees, aiming for more sophisticated investors. And they need at least 50 LLTs.
A platform for the next generation of tech companies, potentially. And then there's the Social Stock Exchange, SSE. This is quite different.
Very different. It's a dedicated segment on the exchange, specifically for not-for-profit organizations, NPOs, and for-profit social enterprises, FPEs.
What defines a social enterprise here?
The key is the primacy of social intent. At least 67% of their activities must focus on tackling specific social issues listed by SEBI, like hunger, poverty, healthcare, education, gender equality, environmental sustainability, financial inclusion, supporting differently abled persons, slum development, disaster relief.
So it's not just about profit.
No, profit might be a byproduct for FPEs, but the core mission must be social impact. It explicitly excludes corporate foundations, political or religious organizations, and most infrastructure housing companies, unless it's affordable housing. NPOs have to register first before they can raise funds via instruments like zero coupon, zero principal bonds.
A fascinating way to channel capital towards social good. Now back to trading mechanics. Margins, why are they important?
Margins are critical for risk management, especially when trading derivatives or using leverage. The initial margin is like a down payment, the amount you deposit with your broker before you can trade.
And maintenance margin.
That's the minimum equity level you need to maintain in your account, usually a percentage of the current market value of your position. If your account value drops below the maintenance margin level due to market movements, you get a margin call.
Asking for more money.
Yes. You need to deposit more funds to bring the account back up to the initial margin level. If you fail to meet the margin call, the broker has the right to liquidate your position to cover the potential losses. It protects both the broker and the market system from excessive defaults.
Okay. How are very large trades handled? What's the difference between a block deal and a bulk deal?
Both involve large quantities, but the mechanics differ. A block deal has a minimum order size of 10 crore rupees. Crucially, these trades happen in specific, short trading windows outside normal market hours, one in the morning before the market opens, and one in the afternoon after a brief pause.
And the price is constrained.
Yes, it has to be within 1% of the prevailing market price or the previous day's close, depending on the window. The key thing is details of block deals are released after market hours on the same day.
And a bulk deal.
A bulk deal is defined differently. It's any transaction where the total quantity bought or sold is more than 0.5% of the company's total equity shares. These trades happen during the normal trading hours, just like any other trade.
So the reporting is different too.
Yes, and this is important. Bulk deals are reported much sooner. If it's a single trade exceeding the 0.5% threshold, the exchange is notified immediately. If multiple trades cumulatively cross the threshold, it's reported within 1 hour of the market closing.
So bulk deals are more visible to the market in near real time.
Exactly. Block deals signal large institutional action, but without immediate intraday visibility, whereas bulk deals offer much quicker transparency about significant buying or selling pressure.
Got it. So with all this activity, how do we track the market's overall mood or direction? That's where stock market indices come in, right?
Precisely. An index isn't just a number. It's a statistical measure reflecting the change in value of a representative group of stocks or bonds or commodities.
Like the Sensex or Nifty.
Those are the main benchmark indices in India. The Sensex on BSE tracks 30 large, well-established companies. The Nifty 50 on NSE tracks 50 large liquid stocks across various sectors. Both use a free float market capitalization method, meaning they give more weight to companies whose shares are readily available for trading.
What are the benefits of having indices?
They provide a historical benchmark. How has the market done over time? They're a performance yardstick for mutual funds. They act as lead indicators for the economy or specific sectors. They give up-to-date market sentiment. And they form the basis for many financial products. Index funds, ETFs, index futures, index options.
And there are other types too. Sectoral, market cap.
Yes, many others. Sectoral indices track specific industries like auto, banks, IT, healthcare. Market cap indices track companies based on size like mid-cap or small-cap indices.
Okay, so for anyone thinking about actually investing, let's cover the absolute basics of investing. Where should someone start?
The absolute foundation is understanding your own situation. What are your investment goals? What's your time frame? What's your risk tolerance? How much volatility can you stomach emotionally and financially?
And being aware of the risks is crucial.
Absolutely. There's market risk, systematic risk that affects everything, unsystematic risk specific to a company or industry, inflation risk, the danger of your money losing purchasing power, liquidity risk, not being able to sell quickly without a price drop, volatility risk, sharp price swings, and currency risk if you have foreign investments.
What are the practical prerequisites?
You need 3 key things: a bank account, a trading account with a SEBI-registered broker to place orders, and a demat account with a depository participant to hold your securities electronically.
And KYC. Know your client.
Mandatory. It's a one-time verification process under the Prevention of Money Laundering Act. You provide official documents like PAN card, Aadhaar, passport, etc. Once your KYC is done with a SEBI-registered intermediary, it's valid across the market. It streamlines the process.
So we've talked about individual risks, but how is risk management handled at the market level? How does SEBI ensure safety?
SEBI and the exchanges have a multi-layered framework. Securities are categorized based on liquidity and volatility, which affects margining. They use a sophisticated VAR, value at risk-based margining system.
Value at risk?
Yes, it statistically estimates the maximum potential loss on a portfolio over a specific time period with a certain confidence level, typically 99%. This helps set appropriate margin levels. They also have daily mark-to-market margining, where profits and losses are settled daily. Real-time monitoring of intraday trading limits and gross exposure limits for brokers. Strict rules on upfront margin collection before trades are placed. Index-based, market-wide circuit breakers that automatically halt trading across the market if indices fall too sharply too quickly. And automatic deactivation of trading terminals if brokers breach risk limits.
So a pretty robust safety net.
Yes, these measures significantly strengthen market safety, transparency, and investor confidence.
Okay, shifting focus now. Our markets don't operate in isolation, do they? Global events and policies have a huge impact. Let's talk about the U.S. Federal Reserve policy.
The Fed's decisions ripple across the globe. As the U.S. central bank, its actions on interest rates and monetary policy affect global capital flows, currency exchange rates, everything.
How does a change in the U.S. Fed rate specifically impact India?
Well, typically, if the Fed raises rates, it makes U.S. dollar assets more attractive. This can strengthen the dollar against other currencies, including the Indian rupee.
Which makes imports costlier for India.
Yes, potentially putting pressure on our trade balance and forex reserves. Although a weaker rupee could theoretically help exporters, but only if global demand is strong.
What about bond markets?
Higher U.S. Treasury yields, often triggered by Fed hikes, tend to pull global yields up, including India's government bond yields. This makes borrowing more expensive domestically.
And it pressures the RBI.
Definitely. If the rupee weakens significantly due to Fed action, the RBI might feel compelled to raise its own repo rate, or at least hold off on cutting rates. This is to maintain the attractiveness of Indian assets for foreign investors and prevent large capital outflows, which could destabilize the market.
So that leads us to India's own central bank, the RBI, and its credit policy or monetary policy. What are its main goals?
It's a complex balancing act. The RBI aims for sustainable economic growth with price stability controlling inflation, also maintaining exchange rate stability, ensuring enough credit flows, managing the balance of payments, and trying to keep money supply neutral in its effects.
How does it try to achieve this? What are the tools?
It uses several quantitative instruments. The bank rate is a traditional tool, the rate at which RBI used to lend long-term to commercial banks, raising it tightens credit. The repo rate is now the key policy rate, the rate at which banks borrow overnight funds from the RBI against government securities. Lowering it makes borrowing cheaper for banks, encouraging lending.
Okay, what about reserve ratios, CRR and SLR?
The cash reserve ratio, CRR, is the percentage of a bank's deposits they must keep as cash reserves with the RBI. Increasing CRR sucks liquidity out of the banking system. The statutory liquidity ratio, SLR, is the percentage of deposits banks must invest in safe, liquid assets like government securities. Increasing SLR also reduces the funds banks have available to lend out.
And the reverse repo rate?
The reverse repo rate, RRR, was the rate at which RBI borrowed from banks. Raising it encouraged banks to park surplus funds with RBI, reducing money supply. However, this has been largely superseded by the SDF.
SDF, Standing Deposit Facility.
Right. The Standing Deposit Facility, SDF rate, is now the floor of the policy corridor. It's the rate at which banks can deposit funds with the RBI without needing collateral. The Marginal Standing Facility, MSF rate, acts as the ceiling. It's a penal rate at which banks can borrow emergency funds from RBI overnight, even by dipping into their SLR holdings.
So repo is in the middle, MSF is the top, SDF is the bottom.
Exactly. That's the Liquidity Adjustment Facility, LAF corridor. The RBI uses operations within this corridor, primarily repo and reverse repo auctions, though reverse repo's role is diminished now, to manage day-to-day liquidity in the system and keep the overnight call money rate close to the repo rate.
Makes sense. Now, how do inflation indices feed into all these decisions?
They're crucial inputs. An inflation index measures the rate at which prices are rising. In India, the two main ones are the Wholesale Price Index, WPI, and the Consumer Price Index, CPI.
What's the key difference?
Their scope and purpose. WPI tracks prices at the wholesale or factory gate level. It covers a wide range of goods, including raw materials and intermediate goods, so it's seen as an indicator of producer price pressures.
And CPI?
CPI tracks prices at the retail level, what consumers actually pay. It includes goods and services and incorporates taxes and transport costs. CPI is what's used to measure the cost of living and is the RBI's primary target metric for inflation management.
So CPI is more relevant for consumers and monetary policy?
Generally, yes. WPI gives insights into production costs, but CPI reflects the final price impact on households. WPI data collection is often voluntary for producers, while CPI data is gathered by investigators visiting retail outlets. Their base years are also different.
How does rising inflation typically impact the stock market?
Usually, rising inflation leads to expectations of higher interest rates from the RBI to cool things down. Higher rates make borrowing more expensive for companies, which can squeeze profit margins and pressure stock valuations, especially for companies reliant on debt or in capital-intensive sectors.
But it's not the only factor driving the market.
Definitely not. While inflation is a major domestic factor, global market sentiment, foreign fund inflows, government policies, corporate earnings, many things influence market direction. It's a complex input.
So wrapping this all up, what does this deep dive mean for you navigating the financial world? We've seen this intricate dance of savings, investment, regulation, global forces.
It's a complex system, undoubtedly.
Yeah.
But hopefully unpacking it shows how these different parts connect and how fundamental it is to economic progress. It's constantly evolving, adapting.
Which leaves us with a final thought, a question for you to perhaps mull over.
Given this constant evolution, this deep interconnectedness we've discussed, how might the next big disruption, maybe a leap in AI, maybe quantum computing, maybe a completely unexpected global policy shift, How might that fundamentally change the way we invest, the way capital is mobilized here in India? Think beyond what we covered today. What underlying principles might shift? It's something worth considering as this dynamic landscape continues to transform.